Spread trading, which involves simultaneously buying and selling two different contracts, is a widespread strategy in the grain and oilseed markets. A key spread trade in the soybean market is what is known as the crush spread. Soybeans are processed into soybean meal and soybean oil through a process known as crushing. The crush spread is the difference between the value of soybeans and its byproducts, and is considered a gauge of the potential profit margin for soybean processors. This module takes a look at the soybean crush using soybean oil, and soybean meal futures, including the various alternatives for executing the crush at the exchange. This segment will be valuable for processors who use the crush spread as part of their hedging strategy and speculators who look to the crush spread for potential trading opportunities. Nearly 2 billion bushels of soybeans are crushed every year. In the crush process, soybeans are cracked to remove the hull and then rolled into flakes, which are then soaked in a solvent and then put through a distilling process to produce pure crude soybean oil. After the oil has been extracted, the soybean flakes are dried, toasted, and ground into soybean meal. The availability of futures markets in soybeans, soybean meal, and soybean oil allows processors to protect themselves against rising soybean prices, as well as the possibility of declining prices for processed oil and meal. In a crush spread, the trader takes a long position in soybean futures against the short positions in soybean meal futures and soybean oil futures. This is also known as the board crush. The value of a crush equals the soybean oil futures price plus the soybean meal futures price minus the price of soybean futures. So how is this crush actually calculated? First of all, soybeans, soybean meal, and soybean oil all trade in different units. Soybeans trade in bushels. Soybean meal trades in tons. Soybean oil trades in pounds. So in order to perform an accurate calculation, the prices of the three commodities need to be converted to a common unit. A bushel of soybeans weighs approximately 60 pounds. Since soybean futures are priced per bushel, we can alternatively think of the soybean futures price as the price per 60 pounds of soybeans. Then a conversion factor is applied to the futures prices of soybean meal and soybean oil. A bushel of soybeans produces about 44 pounds of soybean meal. Since soybean meal futures are priced per ton, multiplying the meal price by 0.022 represents the meal price per 44 pounds. That same bushel of soybeans also produces 11 pounds of soybean oil. Since soybean oil futures are priced per pound, multiplying the soybean oil price by 0.11 represents the oil price per 11 pounds. So the new formula to calculate the crush is shown here. For example, assume the following prices for the soybean futures complex. Soybeans, $10.37.5 per bushel. Soybean meal, $318.80 per ton, and soybean oil, $36.94 per pound. This equation shows how the crush would be calculated in this situation. Therefore, at these prices, a processor could potentially earn approximately 70 cents from processing 1 bushel of soybeans into soybean meal and oil. The crush can either be sold or bought, which refers to the action taken with the soybean oil and meal futures legs. Selling the crush means selling soybean oil and soybean meal, and buying soybeans. This is the trade typically used by hedgers. Buying the crush, which is also known as the reverse crush, means buying soybean oil and soybean meal and selling soybeans, and may be used by traders who anticipate movements in the market that could make this strategy advantageous. One of the benefits of trading the crush at the CME is that rather than legging into the spread, which means that each individual component of the crush must be traded separately, the soybean crush can be executed on CME Globex as a single trade. At every stage of the soybean production chain, from planting and harvest to exporting and processing, each market participant faces the risk of adverse price movements caused by the vagaries of the market and supply and demand. Futures and options on soybeans, soybean meal, and soybean oil, as well as the soybean crush, provide a means to manage this risk, as well as take advantage of potential profit opportunities.